All right, hello and welcome everyone to the Main Street Ladders webinar. My name is Patrick Kaiser. I'm the Executive Director of Heart on Main Street. Heart on Main Street is a nonprofit organization dedicated to helping independent retailers evolve their businesses and thrive within their local communities. This is a monthly webinar series that's positioned to help connect independent retailers as well as business communities with people that are knowledgeable and experts within their field. And so today, my guest is the founder and CEO of She Profits Now, Christyne Gray. Christyne, thank you so much for being here. I'm so happy to have you on.
Thank you, Patrick, for inviting me. I'm excited too. It's fun to reach out to your community.
Yes, absolutely. Christyne founded She Profits Now in 1997. So she's approaching 30 years of business and coaching, high achieving. I was from She Profits Now, mostly women in the boutique and retail industry to help manage their money and stop the financial chaos and build not only profitable businesses, but profit forever businesses, which I absolutely love. So let's dive in. Tax season is coming, whether we are ready for it or not. And so now is the perfect time to start looking at that. And I know taxes can feel daunting and it can be a scramble for retailers who might not be putting money aside all year like they should. So Christyne's going to talk to us today about what we need to do in order to create less stress and more clarity, which I think we all need in this world. So I'm going to turn it over to you, Christyne, and for you to share with us.
All right. Thank you, Patrick. And thank you guys for those of you who are here with us live, obviously. And then, of course, anybody taking the time on replay. What I hope that you gain from this time together today is that you not only step into your tax season with hopefully a little bit more of a relaxed mindset around tax, maybe a little bit of a less scrambling perspective around tax, but also feel a little bit more anchored around the tax circumstances and scenarios and even just opportunities that are right here specific to us in our unique industry. Okay. So I want to again thank everybody here and Hearts on Main Street for having me. It's very special for me to be able to be here. Your community is very strong and has such an amazing purpose for each and every one of us that live and breathe all things independent small retail. And without independent small retail, I believe that we would have lost the community and connection that we seek through beautiful products that we all need and love and require in our lives. So, all right, so let's deep dive in. So you've registered for this tax season webinar, and that truly does tell me something about you and your CEO perspective in your business and your role as CEO and how you respect that role. It's also telling me that you care, right? Like you care about your business overall. You care about your business's financial health and the strategies behind retaining as much profitability and cash flow in your business as possible through opportunities, right? Like where are opportunities that you can lean into? You care about doing this right, like doing business right and the financial aspects of it. We know that you're creative. Like this is a creative industry, which in many instances makes the dollars side of taxation and financial statements and financial planning and cash flow management a little bit intimidating, but that is what we are here for at She Profits Now, and that's what the entire purpose of this particular webinar is about. So we don't want you to feel behind or confused. We want you to start anchored in knowing that here at She Profits Now and how we teach tax strategy. We actually lean into a titling called Tax Savvy CEO here at She Profits Now and through our Financially Fabulous coaching program. And what that is when you become a tax savvy CEO is you are leading into tax season, truly understanding and knowing and accepting that tax season is not stressful because of the paperwork side of business, right? Like I believe that there's that misconception to go, okay, it's tax season. We're coming into the end of February. My tax accountant is asking me for all of the information for them to get busy with their work. And the paper side of this is very stressful because it's time consuming. It's very administrative for you. And we know that time is very valuable. And the financial aspects is not what we want to be dealing with top level. However, I want to have the conversation first with you that stressfulness, it is there because it's actually revealing what you have not led throughout the year. Okay. And this is not criticism. It's truly a reality of what we see and what we participate in with our independent small retailers and the creative mind that is backing our successful retail businesses. So most independent retailers, they were never taught how to lead the financial side of their business. So you learn how to merchandising and you're unbelievable at merchandising. You're unbelievably talented at your branding. You are amazing at community building, and you probably thrive in the customer building experience, as well as even just the product design and product collection building and all things. So this is where your genius zone is. But no one ever really sat down with you as a creative, or maybe you've told yourself that truth and that story. It's not your truth. It's you've told yourself a story that has become your truth, that you're not good with numbers, you're not good with math. Maybe you're ADHD around all things number because we are creative. We're maybe not as analytical as we desire to be. But the biggest thing here is it's not a you issue. Like none of this is a you issue. It's not a paperwork and a paper shuffling issue, and it's not a you issue. This is that you were never taught. No one ever sat down with you and said, okay, here's how profitability works in your business. Here's how profitability connects to cash flow, how cash flow connects to inventory, how cash flow and inventory in your operations connect to payroll, and how all of that is interconnected in your tax scenario and tax circumstances. Nobody ever sat down and actually showed you the rhythm behind all things tax, which is why it makes it feel very paper heavy and just compliancy driven, when in all reality, tax is an all year scenario and a circumstance in your business. It's something that you should be looking at and considering and learning about and growing your knowledge and responding to that knowledge all year long. So I want to anchor this. I'm going to keep anchoring this, and then we're going to get down to some very meaningful areas of tax strategy, tax planning, what I want you to be aware of, where I see the opportunity maybe isn't being discussed under a general tax accountant conversation and relationship that you might be holding right now close to you. So when you are taught and when you are given the tools and the knowledge to lead your business with that interconnected ecosystem of profit, cash flow, inventory, and operating expenses, and how they relate to tax, it becomes a lot simpler. Now it's just a task at the end of the year. We've got to close out our tax year. It's just part of our responsibility, but we've been planning for it all year long. We've been organizing for it all year long. That's where I want to anchor you in this conversation. So obviously we've got to clean up any messes from 2025 that leads into this year's tax planning, tax strategy, and tax preparation and filing. But this is the perfect time, February 25th of 2026, that we can lead our businesses through 2026 with tax being a top priority month over month, so that we don't have the burden and the weight at the end of the year and leading into January through April. All right. So the reason why March and April show up as heavy as they actually are is that you have put yourself unintentionally, inadvertently into a reactive phase. You're in a reactive state of mind and a reactive financial space. This might feel like judgment when I'm saying this out loud, right? Like I'm leading you right into areas that you maybe feel like I'm identifying have been amiss for you as a CEO and in your operational efficiencies and effectiveness and systems and processes. But that's not the case. It's not a judgment, and it shouldn't actually feel like a surprise to you. This is more about us closing in on what we can do better through systems into the future, right? So today isn't entirely a conversation about loopholes and tax strategies, even though I'm going to give you some hints on areas that you can close the gap and save some money on taxes. It is actually, and it's not an area about being aggressive with deductions. It's about how do we lead into becoming a tax savvy CEO so that we can close out the year 2025 on our tax return with more awareness, and we can start to get organized in 2026 so that we can capture tax savings opportunities throughout the year, so that we're not looking back and paper pushing, creating that entirely heavy tax strategy burden at the very end of the year when it's maybe a little too late to even respond and react. So instead, it's about leading us forward. So tax is not a season. I want you to like write that down if you're taking notes. Tax is not a season. When you hear most tax accountants, they're like, it's tax season. It's time to reach out. It's time for me to finally connect with you the first time this year because it's tax season. No, that's not the case. Your tax accountant, your professional accounting and bookkeeping relationship should be built into your ecosystem of financial oversight and management, again, all year long. So it's not about reflection. It's not about being reactive. It's about being proactive. So let's lead that into why tax season feels so heavy. And it does, right? Number one, your tax accountant is coming at you with a big long list of everything that they need. They're maybe putting a deadline on you. Maybe they sent you an old school postcard to say, here's the date that's your tax meeting. This is when we're going to sit down and prepare. Bring everything to us beforehand or at that time, and you've got to accommodate. And or you're chasing them down. They're not asking you any questions. They're not asking you if your circumstances have changed. It's maybe been a very haphazard and untimely relationship. That's why tax season feels so heavy. So we're going to go through some of what's happening in your business to where you have control out of the heaviness to get you aligned to being in that proactive state of mind regarding tax being all year long, not just a season in 2026. So tax stress usually comes from one of four areas in your small retail business. And it's not because it's a season and it's a month on the calendar. It is because your business has possibly been inconsistent with profitability. That makes tax season feel really heavy. You maybe have cash flow pressure and have not planned for tax circumstances. That is going to make tax season feel very heavy. You possibly have an inventory imbalance, which you are sitting in a space, maybe being told we can write off all inventory. No, we can only write off what the cost of goods sold is. If you don't sell through your inventory, you're being double taxed. I've heard that one, and it's complete inaccuracy. Inventory imbalance and truly understanding the taxation of the inventory that you have sold and that you still carry as inventory at cost value on your balance sheet. We're going to talk through that a little bit as we go today. But inventory imbalance and the taxation around inventory overall creates an extreme amount of tax season stress. And then just overall entity and payroll confusion, right? Like confusion around I'm a sole proprietor. I'm a single member LLC. I'm a partnership LLC, and I have to file a Form 1065 tax return. I am an S Corp, or maybe I should become an S Corp. I'm not being told straight up that I should be an S Corp or why I should or should not. There's a lot of confusion, especially in independent small retail, around the best entity structure for you and your business to optimize taxation, your tax saving strategies and opportunities without creating a ton of additional unnecessary expenses. A lot of confusion. And then if you are an S corporation, how much should you be paying yourself? How much is officer salary? Fair and reasonable compensation. What does that even mean? And how much can I take for distribution of profits? And which comes first? There's so much confusion around it. And it's just because you likely are in a space where your tax accountant is a general tax accountant. They don't specialize in retail. They don't specialize in inventory. When they read the tax law and they apply tax law, they're thinking of you in a very general capacity, not, hey, I'm reading this tax law. How does it apply in my industry specifically? Knowing how my business operates, where they spend their money, why they spend their money where they do, and how are they building a brand that is potentially even a lifestyle brand. So I'm going to talk to you a little bit about that as we go today too, is building an actual lifestyle brand out of your business so that you can lean heavier into tax strategy and very viable tax laws based on the format of your business. So again, entity, lifestyle brand, payroll confusion. That is why tax season feels so heavy. A lot of unanswered questions, a lot of generalized advice, communication with maybe tax accountants that are only focused on your business at the end of the year and the beginning of the next year because it's their tax season, we're going to eliminate a lot of that. Okay. But to do so, we're going to continue to have honest conversations, which is how I started this entire webinar, is honest conversations on why it feels so heavy, and the reframing of our mindset that is very necessary to just make tax season, tax time, no different than any other month in your business. It's just one compliancy responsibility that we've got to take care of. It's got a month assigned to it, March and April, and we go with the flow. It's not stressful at all because we put ourselves in a position that we are leading it. Okay. So you can have a strong sales year and still feel panic in April. And the reason behind this is because revenue is not profit. We know that, right? So cash flow and the cash flow positioning of your company is one of the first places that we've got to start relative to your tax flow, your tax strategy. No matter what, revenue is not profit. We know that. Okay. So we produce our revenue. We've got our cost of goods sold. We've got our expenses. We've got net operating profit. Net operating profit is what we are taxed on. But then we're also spending that profit on increasing our revenue, our inventory levels. We're spending it on maybe buying some assets, some furniture, fixtures, equipments, warehouses, brick and mortar space from a property standpoint. We're maybe paying down old debts that is taking and consuming some of that profit. And hopefully you're taking some profit distribution. But no matter what, all of those areas in our business, as the money passes through the business, passes through your financial statements, it is causing cash flow discrepancy on where is cash flow, where is taxable profit, where's the difference, and how do we mediate tax saving strategies when we actually need cash to lean into tax saving strategies. Okay. So that's part of this mindset. We've got to be able to look at the entire ecosystem. We've got to balance out cash flow and profitability, because we've got to have both in order to have a tax flow circumstance or a tax circumstance. So profit is not cash. We also know that. I just iterated that your profitability flows through your balance sheet. It buys you inventory. It pays for equipment purchases and buildings, possibly, maybe automobiles, and it's paying off old liabilities as well as potentially giving you profit distribution to fund your household. And so the way cash is allocated becomes a large part of our panic when it comes to April. Do we have the money in place to fund our tax liability? In addition to, do we have the knowledge and the strategies in place to decrease our tax liability as much as possible so that we know we've captured opportunity? And again, this comes down to having the right conversations with your tax accountant that understands your business inside and out, understands the stresses on your cash flow and your profitability, and where you're having to spend those profit dollars, and what does that mean to your tax, you being able to actually pay that tax liability and being able to capitalize on tax strategies that need money to do so. Okay. So what I did there is, it might seem that I was a little scattered on how I brought you through your business and where your profit and your cash flow shows up. But all I'm doing is literally saying out loud what you are feeling and what is happening, boots on the ground in your business, numbers in your bank account every single month. And then it just gets defined as a stressful situation at the end of the year. And that's what we're trying to eliminate. So at the end of the year, retailers we end our tax year with likely inventory stacked high. This is what we see. Okay. So this is where cash becomes an issue, but we may have tax savings opportunities. We need cash for tax savings opportunities. We need cash to pay our taxes once we've optimized tax strategy. But some of the areas that cash flow has passed through your business and or through your household, and we're going to talk about that also, areas that you might be writing off, that you might not be writing off in your life, that truly is viable tax deduction strategies if your business and your brand is established and set up in a proper format. That's that entity conversation. So inventory might be stacked too high. How can we lean into tax strategy around your inventory? If your inventory is stacked too high, there's tax strategy behind it. Margins might be too thin. We've got to fix margins in order to have profitability, in order to have cash flow. Payroll might be heavier than planned. That is causing stress and strain on your tax situation. and you have no deductible tax reserves, or you have no, dedicated tax reserves, which means you haven't protected tax savings money. Okay. So then the bill comes for your tax return. We panic. We feel like the bill is unfair. We feel like our generalized tax accountant didn't do enough for us, but they just weren't responding throughout the year. It's too late to do enough for you. So again, this is where this conversation leads today. So where I want to again anchor you right now in what I just iterated, following the money through your business, outline probably how you're feeling about the financial aspects of your business, what's showing up in your profitability statements, what's showing up on your balance sheet, how is the cash looking in your bank account the end of February going into a due date of a tax return, potentially March 15th or April 15th, depending on what forms you file. Tax strategy requires profit. You've got to be profitable in order to need tax strategy, but you also have to be profitable to have a sustainable cash flowing company. So profit should always be your first priority. Then tax optimization, that should be a knowledge base opportunity for you, or priority for you, where you are leaning into learning about areas that you can optimize your tax strategy. But also commit to the fact that if you want to optimize your tax deductions, you've got to have cash flow to do so. So we've got to put ourselves in a position where we are intentionally leading two areas of our business, profit and cash flow. Those allow us to be in a position where tax season doesn't feel as reactive, and where tax season is more planned out and strategic, no different than all of the other creative fun side areas of your business. All right. So in She Profits Now, if you're unaware, She Profits Now is actually a professional services firm. And what that means is that She Profits Now, we offer accounting and bookkeeping services for retail only. We are embedded in this industry only. The only bookkeeping that we take on above and beyond is when you yourself have a portfolio that maybe has another secondary business that we lean in and take your entire portfolio. So we do She Profits Now professional services is accounting, which is your bookkeeping, financial statement reporting, sales tax, compliance and filing, and income tax strategy and preparation and filing. So that's She Profits Now. But what we also have in play as a sister company is our Financially Fabulous coaching program. And a lot of what we're talking about today is conversations that we have in that coaching program, where I said we've got our own terminology of Tax Savvy CEO. It's a series that we run, and I'm literally giving you snippets of that series of education in our Financially Fabulous coaching program. So Financially Fabulous coaching is where we teach tax, like relative to this conversation, is in Financially Fabulous. We are teaching you the entire ecosystem of your business financially, and how one area is interconnected to the next, right? Like your revenue is connected to how your business is performing with sales metrics, inventory metrics, customer metrics, and financial metrics. Then that's your revenue. Your revenue is dependent on those metrics performing at a higher level. It's also obviously dependent on your talent as you lead your brand. But then your revenue predicts your inventory planning. Your inventory planning predicts your markdown strategy and your margin and your turn rate. Your revenue and your inventory planning is a huge predictor of your cash flow and your profitability. And your cash flow and your profitability is a huge predictor in your tax strategy and tax expense. Okay. So that's how it all leads together. And no one area of your business should be focused on without taking a huge level of consideration for the next area. It's all interconnected. It's an ecosystem. One action creates another response in each area of your business. And so what we coach in Financially Fabulous, leading into what we're here for today, is that tax is really truly just a byproduct of your leadership. And that's what we're establishing. And it is not a separate department, and it's not a separate timeline on your calendar. So please own that truth. And I promise you, if you do and you make tax a part of your year-round self, tax is going to just become another decision that you're making when you're making all of the other interconnected decisions. Tax is not siloed over here in and of itself. It is part of your entire ecosystem and infrastructure of decision making. Okay. Every decision that you make in your business operationally, marketing wise, customer wise, inventory, it touches a dollar in your business, and it also touches a tax circumstance in your business. And that's why we feel stressed, is because nobody else is having this conversation with us. They're not changing our mindset around tax and saying, okay, yeah, this actually makes sense. Everything I do affects my tax circumstances. And if I understand how my actions affect tax come tax time, I can now plan for tax all year long through just mindfulness and awareness in every decision that I make. And that's what we're coaching here. So taxes are influenced by how you price, what your gross margin is, how quickly your inventory turns, how you structure your payroll, how you pay yourself, how you structure your entity, and how you allocate cash. But above and beyond that, how you build a lifestyle brand. How much can we actually write off? How are you building a lifestyle brand to be the highest level of tax deductible as possible? We call it write off your life. In some of the conversations, which sounds like a beautiful thing, right? It is everything I just named, which is how tax is influenced by all of those things. That is every single day, every single week, every single month in your business. You are managing those areas and segments of your business. Now loop tax in to be part of that ecosystem. Tax season is not January to April, okay? So tax season is how you spent your cash flow in July. It is how you marked down and sold through product in October. It is how you paid yourself throughout the year and how you structured your entity and managed your entity overall. And it's how you allocated your profit every single month to your balance sheet items. We touched on that. I already alluded to it. Your inventory. Where did your profit go in your inventory? In buying tax deductible fixed assets, in paying down debt, in saving money on interest, in taking a profit distribution. What's your entity structure? Are you allowed to take profit distribution before you take a fair and reasonable officer salary if you're an S Corp? Did you take a fair and reasonable officer salary? These are all things that you could see and hear as I say them, that this is all year long. That this knowledge that you're taking with you today will help you mitigate end of your decisions, knowing that you are making the decision in the everyday flow of your CEO decision-making capacity just through growing your own knowledge, right? Knowledge empowerment is what we're looking for here. So when you're handling tax circumstances all year long, along with every other decision you're making, all of a sudden March and April feel calm. You've got this. You've already mapped it out. You've already planned for it. Your financials have actually been telling you exactly where your tax liability is going to be come March and April, because you set them up to tell you that, which is actually what we do at She Profits Now too, by the way. We give our clients not only your financial statements every month, and whoever you work with for your tax or for your accounting relationship, make sure that they understand tax. Your bookkeeper should know tax inside and out in your industry. And your bookkeeping, when you receive it, it should always be up to date, accurate. You should get financial statements every single month, no matter what. They are telling you what your tax liability is gearing up to be. It is also telling you where you are using your money, so you make sure that you shift into a cash flow strategy that also involves taxation, tax liabilities. But more than anything, we give here at She Profits Now, where I was going with that, we give you all of that on a monthly basis, but we also give you a financial health dashboard that says, okay, if you, Sally, have a household effective tax rate of 30%, your profitability is $30,000 year to date. That's telling you you have a $9,000 tax liability at your doorstep. Do we have the cash flow for that? Are we planning for the cash flow? Because again, if we don't have the cash flow to pay the actual liability that is right now being calculated in your financial statements that you get month over month, how are we ever going to have the cash flow to actually capture additional tax savings opportunities? Additional tax savings opportunities, if I were to just throw a few of them out there to clear what might be unclear in your mind, right? Like where you can't visualize it, it could be maximizing a traditional IRA. You need like $7,500 to do that. You've got to have the cash flow to invest in the IRA to save the tax percentage on that investment and that deduction. Maybe it's a health savings account. Maybe it's buying a vehicle. and you've got to have a down payment for that. What does it look like in order to optimize? Maybe we're going to lean into that lifestyle brand concept that I keep hinting to, and we've got to do a few investments. So protecting dollars for tax liability also gives you dollars to save tax because we have the money to do so. So that's a shift that I want you to really lean into. And again, I'm going to go backwards to say one of the first things that I said is that your tax flow, your tax stress and strain that you are feeling right now in this season, it is not a tax season issue. It is right out of the chute an organization issue for you throughout the year. And it is showing up during tax season. It's something that we can mitigate going forward, which is why I wanted to start this conversation there, is because I almost want to save you from the future. I'm not a Band-Aid kind of gal, right? Like that's why we have our coaching program. That's why we're so interactive with our clients relative to all things retail, is we're not here to Band-Aid a situation and just get you over a speed bump. We are here to give you a pathway that makes most sense for you financially so you can optimize profitability in all areas of your business, the entire ecosystem, while also protecting your cash flow for the purposes that it needs to be assigned to, that just come up in business, right? Buying inventory, paying your operating expenses, paying your taxes, decreasing debt, and paying yourself. All right. So that's why we start out with what is the true problem. Let's have the hard and honest conversation. And now let's eliminate the pitfalls. Okay. So I'm going to come in and I'm looking at the chat and I'm just going to make sure that there's nothing. Okay. I'm not seeing anything in chat and I'm not seeing anything in Q&A yet. If you guys want to make sure that you interact with me, I will come back and I will answer those questions. And maybe what I'm going to talk about next, maybe if you could, if you're live with me, go into chat and just give me one takeaway from what we've spoken of so far. I want you to document one takeaway for me. All right. So let's move forward while you're documenting a takeaway. Let's do this. Tell me what you've learned so far and what you're going to lean into and what you're committed to so that you don't have tax misery forever and ever in your entrepreneurial journey. All right. So now let's talk about common retail pitfalls. All right. So the most common issues that I see in independent small retail is number one, the inventory myth is what I call it. And it's one that I lean so heavily in because we have an environment here in the retail industry where we have retail specific bookkeepers, but they're not tax accountants. So they're just recording transactions and giving you your financial statements and leaving you to interpret those financial statements, as well as leaving you to have the conversation with your tax accountant about those financials and how they affect you tax-wise. Then on the other side of it, we have tax accountants who don't understand. They're very general. They don't understand the retail world. They don't understand how the money flows through your business, boots on the ground, how you operate the business. They don't understand what you touch every day in your business that could potentially be a write-off. When I say touch, where do you spend your money? They don't understand your technology and how your technology reports your sales, your cost of goods sold, your inventory, and your profitability. Your world is foreign to them and they are generalizing your tax circumstances. That's a problem. But then they're also maybe not connected to the bookkeeping process. And that's a problem because now we don't have the cohesiveness to understand the transactions, how they're booked and recorded, and how they relate to your tax circumstances and opportunities specific to retail. Reading the tax laws specific to retail is a different interpretation. It's the same law, but it's different interpretations than what tax is to farming, to manufacturing, to service-based businesses, to construction businesses, completely different. Okay. So that's where this, and then we have inventory planners. We have inventory planners over here that don't understand bookkeeping. They don't understand tax. They maybe are trying to help you with their cash flow, but they're also telling you to sell through your inventory as fast as possible at the end of the year, end the year with as little inventory as possible because you're going to be double taxed. That is the inventory myth. All of this is happening, right? So there's inventory myth happening in the bookkeeping process that never flows to the tax accountant. The tax accountant has their own perspective of how your inventory flows through to taxation. And then your inventory planner has a different perspective. And you in the middle are trying to mediate what is truth. So that's why I love this conversation is we're accountants degreed, which means we perform your bookkeeping. We also are tax accountants certified. Strategic, why, like I've been doing tax returns for almost 30 years. Yes, that ages me, but I'm going to just lean into the fact that I'm working really hard at aging gracefully. And I'm proud of those 30 years. So I have done tax in this industry for 30 years. And through Financially Fabulous, we are inventory planners. So we can loop all of the truth and reality around inventory together and teach you exactly what the inventory myth is and is not, and where you can take opportunities through taxation relative to um, your inventory and how you're carrying your inventory and how you're writing it off and how you're depreciating it at the end of the year and or selling through it. Okay. So here's what I hear every single year is if I buy more inventory in December, I will lower my taxes. That is not true. So a good tax accountant is always going to try to marry up income to expenses in the same time period. That is going to keep you in a very healthy inventory, in a very healthy profit position, in a very healthy tax position going forward, as well as cash flow position. It is also going to allow you to report your profitability as true and accurate month over month, year over year, which is very beneficial if you ever try to sell your business. And it's very beneficial when you go to a bank and you try to borrow. Okay. Accelerating deductions are not always in your best interest when it comes to inventory. We want to marry up the timing. When you buy inventory, it is an asset. When you sell inventory, it moves from an asset and it becomes a cost of goods sold, which decreases profitability. You have revenue less cost of goods sold equals gross profit minus expenses equals profitability. So when you hear or you say to yourself that if I buy more inventory in December, I'm going to lower my taxes, I want you to defer to this conversation. That is not a healthy way to manage your taxes or your inventory. We want to see on your balance sheet what levels of inventory you are carrying in your back room, on your floor, from a cost value. If it's unsold, it is an asset. So inventory is not an expense when you buy it. It is an asset until it sells. Okay, only the portion that sells becomes cost of goods sold. So overbuying in Q4 often means that you are straining your cash flow, you are slowing down your turn rate, you increase your markdown risk, and you do not magically reduce your income, your taxable income. Okay. So dead inventory is not a tax strategy. Carried over inventory is not a tax strategy. All it is deferred margin erosion. It is affecting your profitability overall, which affects your cash flow, which affects your viability to continue to sustain this business. And it affects the value of your business and your ability to ever even get out of it if you choose. And someday that choice might come to you when you're least expecting it. So we always prepare for building a strong, viable, business valued business, even if we never plan on selling it today. Okay. So margin erosion eventually increases tax stress because you don't have cash to capture tax savings opportunities. So another thing about inventory that is a myth is if you're being told to sell through perfectly good inventory that could 1 week after the new year be sold at full price, and you're being told to sell through even if you have to discount and take the markdown in order to save on taxes, that is the biggest myth, and I'm going to say misunderstanding of tax law and financial accounting that could ever be out there floating. And here's why is tax or your inventory as an asset on your balance sheet is not taxed from a federal tax or a state tax level, state income tax. The only time that your inventory on the books that you are carrying over from December 31st to January 1st is taxed is 11 states that tax inventory as a personal business property. The max percentage is 4%. And 9 of those states do a hybrid approach. So think about the perspective here, right? If I come into the last 2 weeks of December and I mark down perfectly viable inventory, maybe 20%, I am losing margin on that sale. And then I'm having to turn around in January and buy the perfectly good merchandise to sell again. So now I've lost payroll costs on the buy and the sell and the rebuy of perfectly good merchandise. I've taken unnecessary margin markdown to meet a myth that I've been told that I'm going to save taxes on that inventory. I've maybe taken 20% markdown. I've taught my customer to wait for the last 2 weeks of the year to buy product because I mark it down and it's perfectly good product. I've consumed my customer's budget. So now when I want to sell to them in January, their budget was just consumed on 20% markdown, perfectly good merchandise 2 weeks before the sale, my 2 weeks prior to my markdown at end of year. They waited because they knew that I was going to have a sale. I've trained my customer to wait for the markdown. I've eroded my margins. I've increased my payroll expense in order to buy, sell, and have to rebuy perfectly good merchandise just to take a lower margin to save on taxes. That is actually a myth. Because here's what happens is your inventory that you carry over at the end of the year, December 31st, does not have a tax circumstance. It is just an asset sitting on your books. And if you are in a personal property tax state, you are being taxed about 4% at the most. Most of them are more around that 2-3%. And would you rather take a 2-4% tax hit than a 20% markdown on that very same inventory while losing customer margin, spending the customer's budget? They no longer are coming in January and paying full price because they just bought it on discount 2 weeks before. So there's a myth here that's causing this unseen strain that is a complete lie around the taxation side of your inventory. So I want you guys to know that and really embed in the fact that, yes, we don't need you to be buying additional inventory at the end of the year for a tax deduction. That's a myth. And please do not mark down perfectly good inventory at the end of the year either. So let's talk about the flip side of that. This is tax strategy in motion. So the flip side of that on your inventory is always make sure that you do your physical inventory count at the end of the year, because anything that was lost, damaged, stolen, and or severely distressed, meaning aged out, should be written off. All right, so you do your physical inventory count, you catch any losses through shrinkage. We write those losses off at the end of the year. That physical inventory count allows us to catch those losses. That is a true and very smart tax strategy. But then here's what also we have is another tax strategy that is a little harder to comprehend if you're not like right in front of it on paper and see the difference, is if you have distressed and aged inventory going into December 31st that you maybe plan on doing, like say a warehouse sale in January, and it's like high hopes that you're going to be able to sell some of that inventory in January because it's just seriously aged and distressed, we can actually do a complete write down of that inventory to zero cost. So let's say an item is, let's say it's cost $10, retail $30. You've been gradually marking it down. The cost is still $10, but maybe you got right now the markdown price of it is $15. And it's still sitting there and it's aging and it's not being sold. We've got a cost of 10, a markdown from 30 to 15 for your retail price of it, discounted. What you can do, if you know December 31st that that product is seriously distressed and it is high hopes that it will sell in your strategic sales initiative, end of season sale in January, maybe even February, we can come in and we can say, all right, the 15 discounted sale price is probably not our new reality going into our warehouse and our season sale. It maybe now is a $10 reality, or maybe even a $5 where we take a loss because the true cost was $10. We can actually come into your point of sale and say, we're going to leave the quantity there because we are going to try to sell through and get pennies on the dollar for it, right? We'll take a loss on it retail wise, but in December, you can come in and you can say, I'm going to write down the cost to zero, take the cost of goods sold as a deduction. And when we do sell it, if we do sell it, I'll just take the revenue without the cost because the revenue is so little that I don't need to marry those two up in the same time period. So all you're doing there is we're essentially depreciating that inventory on December 31st to say it has a zero value. We don't know if we're going to end up discounting it or donating it, dumpster firing it, or maybe sell it on a $5 rack. But I'm going to take the write-off as a write-down, a depreciable write-down. It is worth zero. I'm going to take the cost value as a write-off December 31st for current year tax, because it is an opportunity timing to take the tax savings in current year, save on taxes, and get that tax money back into circulation rather than a tax bill. So we've got a couple inventory myths, but then we've got some inventory strategy for tax season. So those of you guys listening, what I would like for you to do is relative to your inventory. What is one thing that you can do? Like, give me a chat response, type in the message. What is one thing that you can do relative to your inventory going to take you into the new year to bring you into a better tax position? What's your one takeaway relative to the inventory myths around taxation? All right, so S Corp confusion. Here's another area for our industry that is very specific, and I'm going to share with you. Right now is when we're bringing on a lot of new clients, obviously, right? Beginning of the year, people want to reset. They're joining She Profits Now and coming into our full ecosystem of services, which is accounting, sales tax, income tax, and our financially fabulous coaching program all bundled together. We're taking on a lot of these new clients, and we're having conversation of, oh my God, why are you not S Corp? You have $50,000 profit. You have $60,000 profit. I've got one gal at $150,000 profit. Her general tax accountant told her that her company is not big enough to be an S corporation. There is so much confusion out there. So S corporation status, that election is not for a certain size of business relative to revenue. It is for profitable businesses that have reached a threshold of where their profit is more than what their, as a shareholder or as an owner, of what their fair and reasonable officer salary would need to be as an S Corp. That's all this is. It is just, there's a threshold. Are we above or below the threshold? That's the only decision making. Never should you be told your business is not big enough to be an S Corp, because it's going to have unnecessary administrative costs. That's lazy tax accounting. And I'm going to always be the one to just like put it in your face, you guys, because I live in this industry and I see so much missed opportunity. So new client, just met with her 2 days ago, $55,000 of profit. She did not take a dime out of the business in 2025. So here's what I want to run this by you, this S Corp confusion. I might be putting the cart before the horse in this information, but I was excited to talk through this with you because I feel like it's really eye-opening. Is the rules behind S Corporation and where we're talking about that threshold is when you become an S Corporation from an LLC. So you're maybe a single member LLC or a partnership LLC. And Christyne comes in, me, and I say to you, or my team says, you really truly should consider being an S Corp. We see a ton of tax savings opportunities through this election. It's a tax status election. So with the state, you're still an LLC, but with the IRS, we elect S Corp status for how you are taxed. So your entity stays the same. We just elect S Corp status for taxation purposes. It gives us tax saving strategies and opportunities. It doesn't cost you more to do this if you already have payroll up and running in your business. Retail does. You have employees, you already have payroll. That's the administrative costs that a lot of tax accountants are trying to save you from. You already have payroll. And at She Profits Now, we don't charge you more for an S Corp return. We charge the same dollar amount no matter what type of return you file. We bundle individual with your business return. I don't care if it's a Schedule C or an S Corp, 2 different levels, because we do the same amount of work for you, no matter how your business is being taxed. It's all the same for us. We want you in the same tax position, so there's no price difference. So becoming an S Corp has tax savings opportunity if you have met the threshold. The threshold is determined by fair and reasonable compensation prior to distribution of profits. So write that down. Fair and reasonable compensation for you as an employee of the business and as the owner of the business, the shareholder, prior to distribution of profits. Prior to is a key word here. So we've got 3 things that we're looking at to make an S Corp a good tax strategy for you and to eliminate some confusion. And hopefully those of you guys listening to this to maybe save you some money if your tax accountant doesn't know and understand your industry. And if they don't come to us, like you're always going to get that from me. So your S Corp confusion comes in that if you're, let's just say that you run a small independent retail store, that's what we're all doing here. And when I say small, maybe you are at a $400,000, $500,000 revenue point. That doesn't matter as much as what should you get paid to do the employee roles that you fulfill in the business that you would otherwise have to pay somebody to do outside of you being the owner and the CEO and the big visionary of the company. So let's just say that you come in and you work some shifts, you maybe do the inventory buying, but you're not doing the steaming, you're not doing the shipping, the receiving, all of the things. Like you're doing minimum employee focused work. Maybe you're serving some customers, right? All the things, but you're not scrubbing the toilets, you're not the janitor. What would we have to pay somebody else for the job that you're doing in the company, boots on the ground? Fair and reasonable compensation. That is what officer salary is about. We've got to pay you a reasonable salary for the employee role that you hold in the business. So let's just say that we could easily say that that's $40,000. Okay. You're going to pay yourself a salary for $40,000. That gives you your threshold. Fair and reasonable officer salary prior to distribution of profits. So it means that your fair and reasonable officer salary is $40,000. That's also telling you that if your profit was $55,000, you have $15,000 difference that is no longer self-employment tax like it is under an LLC. So that $15,000 times 15.3% would be your tax savings. That's what it means to you to become S Corp election. So going back to my client that I just met, she did not take a single profit distribution. Fair and reasonable officer salary prior to distribution of profits. She was investing into her business in 2025. So she took no money out, not a dime, prior to officer salary, prior to distribution of profits. Since she did not take a distribution of profits, she's not required to take an officer salary. That means that her entire $55,000 of profit is no self-employment tax. Her tax accountant just costed her $8,600 of tax savings in 2025 because she just joined She Profits Now in 2026 and she missed out on that conversation. So don't let yourself be told that S Corporation is too big for you or that you're too little for it. Instead, lean into what can I save if I am an S Corp versus what will I spend if I'm an S Corporation. And the only rule and discipline that you need to be committed to as an S Corporation is fair and reasonable officer salary for your employment role that you would otherwise have to pay somebody else for prior to distribution of profits. Okay. So then let's go into cash flow blind spots. We're coming along on time here. I want to lean into lifestyle brand deductions. All right. So lifestyle brand deductions, the one thing that I want you to think about that is a huge, massive opportunity for independent small retailers, Main Street retailers, is your retail brand a lifestyle brand for you? Yes, it might be a lifestyle brand for your consumer, for your customer, right? Like maybe your women's apparel with beauty, with accessories, with gift and home, and you do some curating of collections that lean into the entire lifestyle of your consumer. That means that you're a lifestyle brand when it comes to the vision of your brand and your brand model. But let's flip the script here. What does lifestyle brand mean when it comes to deductibility? If you yourself live your brand, you are building a lifestyle brand, okay? So where I want to go with that is let's just say that you are building a lifestyle brand and you've got your independent retail store, your Main Street retail store. But in addition to that, maybe you are also a advocate and a ambassador for health and wellness. And maybe you lean into some multi-level marketing health and wellness products. Like, this is not a conversation of who likes or does not like direct, network marketing. That's not the conversation. It's part of a lifestyle. Then maybe you also own the building that your business is in. That's part of your lifestyle. And then maybe you are also very philanthropic. That's part of your lifestyle. How do we blend your lifestyle brand, how you live your life, and how you present yourself in the community and how you serve others? Is the areas that you serve others through your lifestyle brand deductible? Okay. Retailers by nature are lifestyle entrepreneurs, right? This means we go to market trips. We show up on social media when we're on our market trips. When we go on vacation, we're also bringing collections and we're modeling those collections, or we're demonstrating what products we represent. When we go on vacations or we travel, we're going and doing business development possibly, or we're doing market research. Maybe our content creation is about our lifestyle, and we really bring ourselves and our lifestyle into our brand for know, like, trust. And then maybe we have events at our business that also bring in part of our own lifestyle. And maybe we collaborate with other brands and other businesses in our community because that's part of our lifestyle. Here's the question that you need to be asking yourself is, are you building a Main Street business that is an operating business with maybe a property assigned to it? Or are you building a full lifestyle brand that increases your deductibility opportunity? All right. So what you should be always writing or like keeping your mind around, this isn't about what can or cannot be tax deductible from a checklist standpoint. This is about you leaning into what does tax law mean to you that is unique to your brand and your lifestyle, and how you are living your lifestyle through your brand and how you serve your community and your audience. Your question should always be, if I spend this money over here, whether it be personally or in my business, is it producing the opportunity for me to produce revenue, for me to bring on a new customer, for me to create additional loyalty with my existing customer, for me to get my loyal existing customer through my door another time any given month? Is it creating the opportunity for me to carry out my vision and my goals and my philanthropic sightlines? If it is, you may have a very viable tax deduction. Okay. So you've got to ask yourself those questions when you are making spending decisions, whether they be personal or business. You've got to sit down and build out, what does a lifestyle brand look like for you? And how has this become a tax saving strategy for you, your life, your household, and your loved ones? All right. So it's not about, is this tax deductible? Because my answer to that question is always going to be, does it produce revenue for you? Does it give you brand exposure? Does it allow you to carry out your mission of your brand? Does it allow you to give back to the community through your brand? That's going to be the questions that I ask, not black and white, yes or no, it's tax deductible, it's not. All right. So also you need to ask yourself another question. And is it, when you say yes to all of the, is this a legit write-off that I just rambled off? Ask yourself a secondary anchoring question, and that is, does the spend, like, yes, I answered all these questions. It gives me an opportunity to produce revenue, bring in new customers, nurture my existing customer, lead into my philanthropic vision and goals. If you can answer yes to all of that, one last anchoring question is, does this spend benefit me personally more than it benefits my business's opportunity to create revenue, help others, be philanthropic, bring in my new customer, bring in new customers? Does it affect me? Does it benefit me personally more? And if you say yes, it benefits me personally more, then all of the other objectives that you have by being an entrepreneur, then it is likely not a write-off. Okay. So if it benefits you more personally, then your objectives as an entrepreneur and the lifestyle brand that you're building, then it's likely not a write-off. And that's your anchor. That's your anchor to go, okay, I can't get greedy. I've got to know that this is a legitimate supported deduction for the mission of my brand. All right. So here's what this comes into. It's ordinary, it's necessary, it's documented, but the biggest thing is we can't get greedy and we can't stretch deductions outside of the company that we are leading, but we could be leading our company into a bigger, better vision that leads our souls. Okay? Like, what are you building? And from there, you'll be able to answer what is tax deductible or not, as long as it doesn't benefit you more than what it does your building. All right? So that is then the last. I know we're a little bit over. There's not a lot of questions. Can't get you guys to go into my prompts. You guys are a hard crowd. You're going to lean into me later, though. I'm confident. All right. Cash flow. Here's the one thing that I want to say about cash flow is we do lean into profit first here. Patrick, I see you jumping on, but the last thing to round this out is we said profit, right? Like we got to have profit in order to have a tax circumstance. In order to have tax saving strategies, we've got to have cash flow. You guys, profit first is the best way for you to lean into your cash flow allocation strategy to protect your profit and protect your tax dollars. So we do coach to a 40-20-40 allocation framework. And Patrick, I have this in a mini course, and I would love for your community to just take it and run with it. We offer it as a freebie. Now it used to be a paid course. We took it off of paid profile and just made it a freebie for others because we just see the effects of it. But our 40-20-40 cash flow allocation strategy helps you protect your inventory dollars in a 40% bucket or whatever your margin needs to be on your buys, helps you protect your profit, tax, owner's pay, debt, and reserve dollars, and helps you protect your operating expenses. And we teach it in a way that is very, very meaningful to retail. We teach you exactly how to use profit first specific to retail, independent, small, and how our money actually flows through our business and how we make decisions in our business and use our technology. Okay. So I'll get that to you and your community.
Yeah, that would be amazing. I mean, first off, like everything you've said here, I'm feverishly taking notes. There's just so many, the tips that you've provided, which could carry around in my pocket so we can make sure we got everything squared away. I thought I saw some, couple people writing in. Okay, amazing information. Thank you. But yeah, if you could send that over, we'll send that out with the recording as well. Want to see some people typing, want to make sure we get, if there's any other questions that are coming in, make sure we have time for that. Love profit first. Can't wait to listen to this again. Yeah, I think this is of anything worth a re-listen because I get like writing down all these things. I'm like trying to understand as we're going. This has been fantastic. Thank you.
Wonderful, wonderful. You can see that I always come in and I'm like going, I just don't want to talk about like all these facts that we can Google and we can get on chat and we can ask the questions. This comes down to how do we anchor ourselves to be better tax savvy entrepreneurs. So hopefully that's what I delivered today.
Yeah. And I mean, yeah, I think from right off the bat, it's not a season, which I made the mistake saying tax season. It is not. We need to be doing this all year round and paying attention to what you can focus on and where you can get tax deductions. Yeah. Okay, we've got a couple other.
Our best tax deductions are in the moment. We've got to ask ourselves those questions that I, summarized at the tail end, because it's in the moment when we're literally ready to swipe our credit card in the moment. What card do we charge this on? We've got to ask ourselves the tax question. And if we can answer those two questions responsibly, swipe the card on your business and run with it, right? Like know that you asked the questions responsibly and you have the answer, pay for it with the business. Yeah, versus trying to chase the deduction later.
The whole lifestyle brand concept, I would never have thought about that, really what you're doing here, if it allows you to do what you would like to do from the lifestyle brand of your business, and that's huge. I feel like there's so many people can benefit from that.
Yeah, very much so. I'm glad you recognize that. Yeah.
Of course, yeah.
That's how I love to talk tax. Yeah. Like, what does it mean to us how we live? Because that's how we can, as creatives, we can connect to it when it actually becomes just part of our lifestyle.
And you're right, so many accountants don't understand necessarily retail, and we go to the accountant that's available or the one that we use for our home taxes as well, and it's a completely different ballgame.
Yeah, our sister's brother's mother or something like that.
Right? Yeah, they're going to do it for me cheap. Yeah.
Yeah, exactly. Cheap isn't always valuable. Like I will say that we're not expensive, but it takes a lot to know your industry and to be understood
Yes.
and to guide you, and you will save that in dividends, because once you understand the tax strategy behind your decisions, that's repeatable. It compounds, right? Like year after year after year. Yeah.
Obviously run She Profits Now, but how, if people are listening or are on today, if they wanted to reach out to you, how can they connect with you?
So the best way is to go to sheprofitsnow.com. We're leading everybody into the website. Explore what our business model is. You're going to definitely see that you heard me speak of that ecosystem. We are an ecosystem all-inclusive brand for the reason that we don't want you making decisions in silos. I highlighted that right away. But go to our website, and if you like what you see, how we start the conversation through an intake form. And that allows us to know and understand where you are at in your business today, not only what you're looking for, but where are you wanting to find solutions and resolution and more profitability, and what support do you need? And then from there, we respond back to say, okay, we feel like this is the lane that would give you the right relationship that's best for you and your business, knowing where you're going. And that's what that intake is about.
Wonderful.
Yeah.
Well,
Okay.
thank you so much for being on today. This is a complicated topic. This is something that people do stress about, and I feel like you've made it very approachable for us. So thank you very much.
You're welcome, and thank you. And one very last thing is, as you saw the way I communicated it, tax can actually be very creative.
Yeah.
If you take it in that mindset. Yeah, let's be creative with it. Creative and legal all at once.
Yes, it's in the right side of the IRS. So
yeah, exactly. Patrick, thank you so much for the opportunity. It is a blessing and a pleasure to get in front of your community. What you're committed to and your mission is unbelievable. And I see what you're doing out there, and I'm happy to be a part of it. I need to get more
much,
involved.
Christyne.
Yeah,
Thank you. We could talk later. So I appreciate you being on today. And yes, everyone will receive a recording of this. We'll send out a link to your website so everyone can go there, and we'll make sure everyone gets information they can follow up.
And that the Profit First, the 40-20-40 course is on the website. Now that I think about it, you can find it there as well, but I'll get you the link too. Yeah.
Thank
All
you.
right. Thank you. Thank you, everybody.
Take care, everybody. Have a wonderful
Bye-bye.
day.